I need you to stop looking for a parking spot. I need you to stop arguing with the barista about whether they used oat milk or almond milk, because frankly, in about 6 months, you're going to be happy if you can afford the cup. I need you to pull the car over, turn off the radio, and listen to the sound of history breaking the sound barrier. Ladies and gentlemen, Asian guy here. It is Wednesday, January 28th, 2026. And if you thought the last 48 hours were crazy, you haven't seen anything yet. We have just witnessed a market event that theoretically shouldn't happen. We have just seen the financial equivalent of a total solar eclipse occurring at the exact same moment as a volcanic eruption. Usually, in the world of finance, you have risk on and risk off. When people feel safe, they buy stocks. They buy the S&P 500. They buy tech companies. When people feel scared, they buy gold. They buy silver. They buy the bunker. That is how the seesaw works. That is how the algorithms are programmed. But today, the seesaw didn't just tilt. The seesaw snapped in half. Everything is up. And I don't mean up a little bit. I mean vertical. Let's look at the scoreboard. Because if I didn't see these numbers with my own eyes, I would think the data feed was hacked. The S&P 500, the benchmark for the American economy, the index that tracks the biggest companies in the world, has just smashed through 7,000. It didn't stop at 6,900. It blew right through it like a freight train hitting a pile of styrofoam. At the exact same moment, gold has hit an all-time high of $5,300. And silver? The metal that they told you was dead at $90? It just broke $115. Now, the President of the United States is celebrating. Donald Trump just tweeted out in all caps with about 5 exclamation points, "America is back. Stock's huge. Greatest economy ever." And if you are a casual observer, if you are just a guy watching the ticker on CNBC while you run on the treadmill at the gym, you might believe him. You might look at your 401k balance today and think, wow, I am rich. I made 20% this month. Maybe I should buy a boat. Do not buy the boat. Do not buy the hype. Because I am here to tell you the terrifying truth about what happens when stocks and gold go to the moon at the same time. It does not mean the economy is strong. It does not mean corporate earnings are exploding. It means the denominator is dying. You have to understand the math of a crack-up boom. This is a term coined by the Austrian economist Ludwig von Mises about 100 years ago. He described a phase in the death of a currency where the public realizes that the money is losing value, so they panic buy everything. They buy stocks. They buy houses. They buy art. They buy gold. They don't buy these things because they want them. They buy them because they are terrified of holding the cash. The price of the S&P 500 isn't going up because Apple sold more iPhones today than they did yesterday. Apple is exactly the same company it was on Monday. The S&P 500 is going up because the dollar is crashing down. It takes 7,000 of your worthless dollars to buy the same basket of stocks that used to cost 5,000. That isn't a profit. That is an inflation adjustment. Think about it this way. If you are in Venezuela and the stock market goes up 1,000,000% in a year, are you a genius investor? No, you're starving. Because a loaf of bread also went up 1,000,000%. That is what we are seeing today in New York. We are seeing the Venezuelanization of the American stock market. The everything bubble has become the everything panic. The smart money knows this. The algorithms know this. That is why gold is at $5,300. Gold is the lie detector. If the economy was truly back, if America was truly booming, gold would be crashing. You don't buy insurance when your house is fireproof. You buy insurance when you smell smoke. And right now, gold at 5,300 is telling us that the entire financial house is fully engulfed in flames. And let's talk about Trump's tweet again. America is back. There's a supreme irony here. Trump has been screaming for a weaker dollar for years. He wants to export American goods. He wants to bring manufacturing back. To do that, you need a cheap currency. You need to make American products cheap for foreigners to buy. Well, the market is giving him exactly what he wants. The market is crashing the dollar to oblivion. But the side effect of a crashed dollar is that the price of everything you import, oil, electronics, coffee, silver, goes vertical. So while the stock market cheers the growth, the working class is about to get hit with the cost. This is not a celebration. This is a funeral for purchasing power. But the most dangerous part of this inflation tsunami isn't the price. It is the availability. Because while the screens are flashing green and the president is tweeting victory laps, the physical plumbing of the market is completely seizing up. You might look at $115 silver and think, okay, that is expensive, but at least I can buy it. Can you? Are you sure about that? Because the news coming out of the supply chain suggests that the price is now a theoretical concept. We have reports coming from the manufacturing hubs in China, specifically Shenzhen, that suggest the metal has simply stopped flowing. We need to talk about the Shanghai blackout. We need to talk about what happens when a factory that makes solar panels goes 15 days without seeing a single bar of silver. The lights are flickering in the east, and that darkness is coming here. And when I say the darkness is coming, I'm not talking about a power outage. I'm talking about a supply chain cardiac arrest. You have to look at the news coming out of Shenzhen this morning to understand why the price of silver is vertical. Shenzhen is not just a city, it is the factory of the world. It is the silicon heart of the Chinese electronics industry. Specifically, we need to look at the Hubei district. This is the jewelry and precious metals capital of China. If gold and silver are flowing in Asia, they are flowing through Hubei. Usually, this place is a beehive. Armored trucks coming in, bullion vans going out, refiners shouting orders. But today, we have a report from the local industry newswire that should terrify every industrial buyer on the planet. The headline reads, "Half a month without receiving any silver." I want you to let that sink in. 15 days. For 15 consecutive days, the major wholesalers and manufacturers in the biggest industrial hub in China have received zero inventory from the Shanghai Gold Exchange. They have placed orders, they have wired the cash, they have screamed at their brokers. And the response from the vault managers in Shanghai is silence. The trucks are empty. The arbitrage vacuum that we discussed yesterday, the massive $20 premium that was supposed to suck metal into China, has worked too well. It didn't just drain the West, it drained the floating supply of the entire world, and it still wasn't enough to fill the black hole of Chinese demand. This is the nightmare scenario for the global economy. Silver is not just a shiny rock that you hide in your safe. It is an industrial necessity. You cannot build a solar panel without silver paste. You cannot build an electric vehicle without silver contacts. You cannot build a Tomahawk cruise missile without silver guidance systems. So when the factories in Shenzhen say they haven't seen a silver bar in 2 weeks, it means the assembly lines are about to stop. And when the assembly lines stop, the panic begins. We are moving from a price crisis to an availability crisis. A manufacturer in Beijing does not care if the price is $115 or $200. If he doesn't get the metal, his factory closes, his workers go home, and he defaults on his contracts. He will pay anything. This is why the price is unanchored. There is no resistance level when the alternative is bankruptcy. And think about the ripple effect of this Shanghai blackout. If China is dry, where do they go next? They go to the next link in the chain. They go to Korea. They go to Japan. They go to the refineries in Switzerland. But those places are already being drained. So now the Chinese industrial giants are bypassing the exchanges entirely. They are sending agents directly to the mines in Mexico and Peru with suitcases full of cash, or rather digital yuan. They are trying to buy the ore before it even comes out of the ground. This is a resource war. The breakdown in Hubei is the signal that the official market, the exchange market, is broken. The metal is no longer flowing through the visible channels because the visible channels are empty. So while you're watching the ticker tape parade on Wall Street, and while the algorithms are celebrating the S&P 500 hitting 7,000, the real economy is grinding to a halt. The atoms are missing. And usually in a shortage, you would expect the dealers, the people who sell to you and me, to be bidding up the price to get inventory. You would expect them to be screaming, "I will buy your silver." But here's the twist. Here's the part that makes absolutely no sense unless you understand the plumbing of a liquidity crisis. While the price screams higher, and while China runs out of metal, the dealers in the United States are acting very strange. They aren't buying. In fact, some of them are refusing to bid at all. We have reports of a liquidity freeze in the retail market that contradicts everything the price chart is telling us. Why would a dealer say no to buying silver at $100? Because they are broke. We need to talk about the liquidity trap. We need to explain why you might try to sell your stack tomorrow and find that nobody has the cash to pay you. The window is closing, but not in the way you think. The window is closing because the people who are supposed to be the market makers have run out of the one thing you need to make a market: cash. You see, in a normal bull market, liquidity is abundant. Money flows freely. You buy, you sell, the gears turn. But in a hyperinflationary melt-up, which is exactly what we are witnessing with silver at $115, the gears strip. The velocity of the price move is too fast for the cash flow of the dealers to keep up. We are seeing a phenomenon today that hasn't been seen since the chaotic days of 1980. But this time, it is digital, it is instant, and it is far more dangerous. We are seeing the no bid sign hanging in the window. I need you to listen to me very carefully if you are holding large bars, specifically 1,000-ounce industrial bars or even kilo bars. You might be looking at the spot price of $115 and calculating your net worth. You are thinking, I have 1,000 ounces. That is $115,000. I am rich. But then you pick up the phone. You call your local bullion dealer. You call the big online wholesalers. And you say, I want to sell. And instead of a cheer, you get a hesitant pause. You get a sigh. And then you get the sentence that stops your heart. We are not buying large bars at this time. Or, even worse, they give you a price that is an insult. They say, spot is $115, but I can only offer you $90. This is happening right now. We have confirmed reports from major players in the industry, veterans like Santiago Capital and the anonymous but highly connected depressed options trader who are seeing this freeze across the wholesale network. We have the story of Joseph Wang, a former Fed trader turned analyst, who reported trying to offload physical inventory and getting hit with bids 20% below the screen price. Why is this happening? Is the price fake? Is silver not really worth $115? No, the silver is valuable. The problem is that the dealer is insolvent in terms of liquidity. Think about the dealer's business model. For the last 3 weeks, as silver ripped from $70 to $100, they have been frantically buying inventory to sell to the panic-buying public. They emptied their bank accounts to stock up on eagles and maples. They are long metal and short cash. Now, suddenly the price spikes to $115. If you walk in with a monster box of silver that you bought 5 years ago for $20, you're asking the dealer to write you a check for $50,000. He doesn't have it. He has a vault full of metal, but his operating account is empty. He cannot monetize his inventory fast enough to pay you, and he cannot hedge his risk because the COMEX margins have been hiked to $51,000, so he can't even short the paper market to lock in his price. He is paralyzed, so he does the only thing he can do to survive. He lowballs you. He offers you $90. He hopes you are desperate enough or ignorant enough to take it. If you take the $90, he can turn around and sell it to a refiner or a desperate industrial buyer for $110, making a quick cash profit to keep the lights on. He is charging you a liquidity premium. He is charging you a fee for the privilege of getting cash now. This is the liquidity trap. It creates a bizarre, bifurcated market. On the screen, silver is $115. But on the street, the bid price, the price you can actually get paid, might only be $90 or $95. Meanwhile, the ask price, the price to buy, might be $130. The spread is blown out to $40. This is what happens when a currency dies. The friction of trading becomes so high that the market effectively locks up. You have the asset, but you cannot convert it. You are rich on paper, but you are stuck in the physical. And this is where the psychology gets dangerous. When you see the dealer offering you $90, you might panic. You might think, oh no, the price is fake, it's crashing. And you might sell. Do not do it. Do not sell your generational wealth for a discount to a dealer who is just trying to fix his own cash flow problem. This liquidity freeze is temporary. It is the shock of the repricing. Eventually the cash will catch up. The big industrial buyers, the Teslas, the Raytheons, will step in with their billions and bypass the broke dealers. They will pay the full $115. But in this chaotic transition period, the street price is broken. But there is one man who is not confused by this chaos. There is one signal that cuts through the noise of the no-bid dealers and the panic. It is the most reliable, scientifically proven indicator in the history of financial markets. And it just flashed the biggest buy signal I have ever seen. We need to talk about Jim Cramer. We need to talk about what he just tweeted and why it effectively guarantees that silver is going to $200. If you are worried about the dealer lowballing you, don't be. Because the inverse Cramer just arrived to save the day. Let's go to part 4. Let's look at the ultimate contrarian signal. If the liquidity freeze has you sweating, if the sight of a dealer offering you $90 for your $115 silver has you questioning your sanity, I have good news. The cavalry has arrived. But the cavalry doesn't look like a knight in shining armor. It looks like a bald man on CNBC rolling up his sleeves, shouting at a camera and smashing buttons that make cartoon sound effects. We have just received the single most bullish signal that the universe is capable of generating. Jim Cramer has officially capitulated. We need to look at the tweet that just went out to his millions of followers. At 10:45 a.m. this morning, right as silver was breaking through resistance, Cramer posted this. This silver move is getting ridiculous. Parabolic moves always end in tears. I am going down to the safety deposit box to cash in the family silver. Bears win here. Sell, sell, sell. I want you to print that tweet out. I want you to frame it. I want you to kiss it before you go to sleep tonight. Because in the laws of market physics, Jim Cramer is not an analyst. He is a counter-indicator. He is a cooler. He is the angel of death for whatever trade he recommends. Do you remember 2008? A week before Bear Stearns collapsed and triggered the great financial crisis, a viewer asked Cramer if they should pull their money out. He screamed, "No, no, no." Bear Stearns is fine. Do not take your money out. 5 days later, the stock went to zero. Do you remember Silicon Valley Bank? He recommended it as a strong buy right before it imploded and caused a banking panic. He recommended buying Meta right before it crashed 70%, and then he cried on national television when it bottomed. The man has a supernatural gift for being wrong at the exact moment of maximum impact. So when Jim Cramer looks at silver at $115 and says, sell, what is he actually telling us? He is telling us that the top is not in. He is telling us that we are nowhere near the top. If Cramer thinks it is a bubble at $115, then the real bubble probably doesn't start until $200 or $300. His tweet is the all-clear signal for the algorithm. The hedge funds that run inverse Cramer bots, and yes, those are real things, just switched their leverage to maximum. They are buying because he is selling. This is the psychological fuel we needed. Markets climb a wall of worry. Oh, they crash when there is euphoria. If everyone was saying silver to 1,000, I would be worried. But the fact that the most famous voice on Wall Street is mocking the rally, that means the retail euphoria phase hasn't even started yet. The public isn't all in. The public is listening to Cramer and selling too early. This means there is still massive amounts of capital on the sidelines waiting to panic buy higher. Cramer just guaranteed that the fear of missing out, FOMO phase, is still ahead of us. He just poured gasoline on the fire he was trying to put out. So when you see that tweet, do not get angry. Do not tweet back at him. Thank him. He is doing the Lord's work. He is shaking out the weak hands so the strong hands can accumulate more. He is the reason why, despite the liquidity freeze and the dealer lowballs, the price is going to rip higher. Because the universe has a sense of humor, and it loves to humiliate Jim Cramer. And while Cramer is selling his family silver to a dealer who probably won't pay him full price, the real money, the smart money, is doing the exact opposite. They are not selling. They are draining the vault. We have just received the updated delivery numbers from the COMEX, and if you thought the Shanghai blackout was bad, wait until you see the hemorrhage happening in New York. The paper market is bleeding out. The final stand of the bullion banks is failing. We need to look at the 48 million ounces that just walked out the door. We need to look at the math that says the vaults will be empty before March. Let's go to part 5. Let's look at the drain. While Jim Cramer is busy standing in line at a pawn shop trying to sell his family heirlooms for pennies on the dollar, the entities that actually run the world are doing something very different. They are not selling. They are backing up the dump trucks to the loading docks of the Commodity Exchange in New York and telling the forklift drivers to work overtime. We need to stop laughing at the clown on TV for a moment and look at the ledger. Because the ledger tells a story of a bank run that is accelerating beyond even our most aggressive models. We have just received the updated delivery totals for the month of January. And I need to remind you, as I did yesterday, that January is legally and historically a non-delivery month. It is supposed to be a sleepy time. It is supposed to be the month where the vault managers play solitaire and the traders go skiing in Aspen. But this January, it is a crime scene. The total deliveries for the month have just climbed to 9,608 contracts. Do the multiplication with me. 9,608 times 5,000 ounces per contract. That is 48,040,000 ounces of silver. That is almost 1,500 metric tons. In a month that usually sees 3 million or maybe 5 million ounces delivered, we have seen 10 times the normal volume. And the bleeding isn't stopping. Just this morning, on a Tuesday, a random Tuesday, we saw another 79 delivery notices issued. And who was the bank desperately trying to stop the bleeding? Wells Fargo. The data shows that the Wells Fargo house account had to step in and take delivery of, 52 of those contracts. This means the bank itself is being forced to eat the metal because their clients are demanding it, or perhaps they are frantically trying to cover their own internal shorts before the audit. When a bank like Wells Fargo is scrambling for physical bars in a non-delivery month, you know the panic is institutional. This creates a mathematical impossibility for the COMEX. If we drained 48 million ounces in January and the drain rate continues through February. By the time we get to March, which is the big one, the primary delivery month where the industrial giants show up, the cupboard will be bare. There will be nothing but cobwebs and IOUs in the vault. We are on a trajectory to hit effective empty by February 20th. Effective empty doesn't mean 0 ounces. It means the only metal left is owned by people who refuse to sell at any price, the eligible category. The registered category, the metal for sale, is being vaporized. This is the final stand. The banks are throwing everything they have at the market to suppress the price, but they are losing the physical war. And the smart money, the whales who have been doing this for 50 years, see the writing on the wall. They know that once the physical metal is gone, the only way to get exposure is to own the ground it comes from. They are moving into the miners. We have just confirmed a massive purchase by the biggest whale of them all, 𝒓𝒔'. This is the man who practically invented the modern precious metals bull market. Filings show that he has just purchased another 100,000 shares of Hycroft Mining, HYMC. He bought them at a price of $49.96. Why is he buying a mining company when the metal is already at an all-time high? Because he knows the next leg of this rally isn't about the metal you can hold. It is about the metal that is still in the dirt. When the vault runs dry, the mine becomes the vault. The miners are the call option on the collapse of the COMEX. If silver goes to $200 because of a force majeure, the mining stocks don't just double, they go up 10 times. Sprott is positioning himself for the resource nationalization phase, where owning the mine is more valuable than owning the currency. And notice where this money is coming from. It isn't just coming from cash, it is coming from the great rotation. We are seeing a massive flight of capital out of digital assets and into physical assets. While gold hits $5,300, look at what is happening to the crypto market priced in gold. It is crashing. The ratio is collapsing. People are realizing that when the power goes out, metaphorically or literally, you cannot barter with a digital token. You need atoms. The digital gold narrative is dying, and the capital is flowing back to the original gold. The crypto whales are selling their coins to buy bars, and when they can't find bars because of the dealer freeze, they are buying miners like Hycroft. So we have the vaults draining at a record pace, we have the whales buying the mines, we have the banks panicking to find inventory, and we have the retail public, led by Jim Cramer, selling too early. This is the perfect storm. This is the setup for a bipolar market that will destroy the unprepared and enrich the holders. We need to explain exactly what this means for you. We need to give you the verdict on how to navigate a world where the price is sky high, but the liquidity is bone dry. Let's go to part 6. Let's finish this. So here's the verdict. We have laid out the evidence, and the picture that emerges is one of a financial system that is not just stressed, but fractured. We are living in a bipolar market. On one side, we have the paper reality. We have the S&P 500 at 7,000. We have gold at $5,300. We have silver breaking $115. The screens are flashing green. The president is tweeting victory. The algorithm is screaming growth. But on the other side, we have the physical reality, and the physical reality is broken. We have the Shanghai blackout, where the manufacturing hub of the world has gone 15 days without seeing a single bar of silver. We have the liquidity trap in the West, where dealers are so cash poor that they are lowballing you with offers of $90 for metal that is worth $115. We have the COMEX drain, where 48 million ounces vanished in a single month, leaving the vault effectively running on fumes. And we have the smart money, like 𝒓𝒔', buying the mines because they know the metal is gone. This split, this schizophrenia between the price on the screen and the plumbing of the market, is the most dangerous moment for a retail investor. Because this is the moment where you're most likely to make a fatal mistake. You're going to be tempted. You're going to look at your stack, calculate the paper profits, and think, maybe I should sell, maybe I should take the cash. And then you are going to call a dealer, and he is going to offer you a discount. He is going to offer you $90, and the fear is going to kick in. You're going to think, if I don't take the 90 now, maybe it goes to 0. Do not fall for it. Do not sell your physical silver for discounted paper cash. Think about what you are doing in that trade. You are trading the only asset in the world that is currently in a global shortage. An asset that China is paying a premium for. An asset that industry cannot function without. For what? For US dollars? For a currency that has lost 10% of its value in a year? For a currency that the president himself wants to devalue to boost exports? For a currency that Jim Cramer tells you is safe? That is the definition of insanity. The dealer's liquidity problem is not your problem. If the dealer doesn't have the cash to pay you $115, that is because he is broken, not the silver. Do not bail him out by selling him your wealth for cheap. Wait for the industrial buyers to bypass the dealers. Wait for the arbitrage vacuum to force the price even higher. When Tesla needs silver, they won't offer you $90. They will pay $150. When the Chinese government needs silver for their missiles, they won't lowball you. You are holding the ace of spades. Do not fold just because the other player ran out of chips. And if you ever feel doubt, if you ever feel like the price is too high, just remember the signal we got today. And remember Jim Cramer. Remember that the man who told you to buy Bear Stearns 5 days before it died is now telling you to sell your family silver. He is the ultimate guarantee. His panic is your conviction. If the top was in, Cramer would be telling you to buy. The fact that he is selling means the mania phase, the phase where the public loses its mind and buys at any price, hasn't even started yet. We are still in the disbelief phase, and markets do not crash in disbelief. They crash in euphoria. We are watching the death of the dollar standard and the birth of a hard asset world. The transition is messy. It is volatile. It has no-bid days and limit-up days. But the trajectory is mathematical. The paper is infinite. The silver is finite. And right now, the finite is winning. The S&P 7000 is just the scorecard of the inflation. The $5,300 gold is just the alarm bell. But the empty vault in Shanghai? That is the truth. This is John A.G. The dealer is broke. Kramer is selling. The vault is empty. Hold the line.